Hello class, and welcome to the video lecture for partnerships. The first learning unit talks about the characteristics of a partnership and generalizing the transaction when a partnership is first set up. First of all, what exactly is a partnership? A partnership is a type of business which has two or more owners. Examples are service businesses, professional practitioners such as lawyers and CPAs, and even sometimes convenience stores. Most transactions are exactly the same for a partnership as they are for a sole proprietorship. Excuse me. The difference is in the equity accounts. In a partnership, you will have more than one owner's capital and withdrawal accounts. Partnerships are very easy to form. All it takes is for two or more people to agree to work as a partnership. The agreement can be oral or written. It's recommended the partnership agreement be in writing so it's easier to resolve any legal issues. A formal agreement in writing between partners is called the Articles of Partnership. Two characteristics of a partnership are called limited life and mutual agency. A partnership has a limited life because if a partner leaves the partnership is ended. When a partnership is ended, it's said to be dissolved. Mutual agency means the actions of one partner are legally binding on all partners. For example, if you and I are partners, we have mutual agency. And then if I purchase $100,000 of goods from a vendor for our business and you don't like it, it doesn't matter that you don't like it because we have mutual agency and you are now just as responsible for paying the $100,000 as I am. Two additional characteristics of a partnership are unlimited liability and co-ownership of property. Unlimited liability means if the partnership, as a business entity, can't pay its bill, the creditors can attempt to get payment from the partners themselves. In my previous example, in which I purchased $100,000 of goods, let's say the partnership didn't have the cash to pay for the goods and bought them on account. Then later, when the bill is due, the partnership has no money to pay the bill and goes out of business. The vendor can go after you and I as individuals to obtain the money. Co-ownership of property means all assets are owned by all partners. If you and I are in a partnership, and I give my car to the partnership to use as a business car, that car is now owned by both you and I because we're partners. The last characteristic is taxes. The partnership as a business entity does not pay taxes. Instead, the amount earned by the partnership is reported on the individual's tax returns, and each individual pays taxes on the income of the partnership. This is also the way it works for a sole proprietorship. Let's look at the example in the textbook on page 623. So on June 1st, Jane Reedy and Bill Burr enter into a partnership. Reedy invests from her old business $9,000 in cash and store equipment worth $25,000 with accumulated depreciation of $5,000. The current appraised value of the equipment is $28,000. Also on Reedy's books is accounts receivable of $2,000 with an allowance for doubtful accounts of $500. The partnership will take on the responsibility for a $6,000 note issued by Reedy. And then we have Burr, who invests $20,000 cash in the partnership. So Jane Reedy already has a business, and she's investing her business into a new partnership. We need to record the transaction in the partnership accounting records. The first is cash, so to the partnership this is a debit to cash of $9,000. The second is store equipment. When recording an asset such as equipment, the current value of the asset is recorded. We don't use the accounting records of the old business. Think of it as if the partnership was purchasing the asset and what it would pay. The next asset Jane is investing into the partnership is accounts receivable. In this case, the partnership does record the asset's contra account, allowance for doubtful accounts. This is because the customers who owe money to Jane's old business will now owe the money to the new partnership, and the same risk of some of those customers not paying applies. The last item is a liability. Jane issued the note for $6,000, so she is the payer and has a liability. If she gives that note to the partnership now has the liability. The difference between the assets and liabilities Jane is investing into the partnership is the value of her beginning capital. This is recorded with a credit to Jane Reedy Capital. And then Bill Burr, the other partner, is investing only cash. The partnership records this with a debit to cash and a credit to Bill Burr's capital. I'd like to finish up this learning unit with a problem from the textbook. Let's do exercise 17B-1 on page 647. Ernie Malone and Carrie Mathis form a partnership on July 1st. Malone contributes $39,500. Mathis contributes $27,500 cash and land costing $18,400 with a current fair market value of $33,500. A $29,500 note payable due to Mathis is assumed by the new partnership. So let's start with Ernie Malone. He contributed $39,500 cash. So the journal entry to record his investment to the partnership would be a debit to cash of $39,500 and a credit to his capital account. For the same amount. Okay. Now let's journalize Mathis. So Carrie Mathis invests $27,500 to cash. So that's a debit to cash. So we'll start with that. $27,500. She also invests land, but which amount do we use? We always use the current fair market value, which is what it could be bought or sold for. And this amount is given as $33,500. So we debit land for the fair market value of $33,500. The last item is a note payable due to Mathis for $29,500. So this means the partnership issued a note to Mathis, and the partnership now has a note payable. We record the note payable with a credit to $29,500. Note payable. Okay, so the final part of the journal entry is to record the owner's capital. Her capital is equal to the assets minus the liabilities included in the investment. So if we have $27,500 plus $33,500, that's $61,000. And then we have the liability of $29,500. So if we subtract that, we get $31,500. So that's the amount of Carrie Mathis's capital. $31,500. Okay, so that concludes Learning Unit 1. In the next Learning Unit, we'll cover the calculations involved in allocating profit and loss in a partnership.